Most parents want one thing above all else: a secure future for their child. But when it comes to planning for education or marriage, the big question is, guarantees or market risk? In this video, we'll take a practical look at SBI Life's Smart Platina Young Achiever plan, a child-focused insurance savings plan built around certainty and long-term planning. No hype, no selling, just a clear explanation to help you decide whether this kind of guaranteed plan fits your thinking. Here's what we'll cover in detail. First, a plain explanation of what the plan is and how it works. Then we'll break down core features like guaranteed benefits and the waiver of premium. Next, we'll explain policy benefits, maturity benefit, death benefit, and waiver of premium, and show guaranteed additions and payout choices. We'll walk through a full scenario example, eligibility and numeric plan parameters, the financials, premiums, loans and taxes, policy lifecycle and revival rules, exclusions and free look rules, and finally who this plan is best suited for. This is a savings cum insurance plan created specifically for children. It is individual. The policy covers one child as the life assured. It's non-linked, meaning returns are not tied to the stock market. You get guaranteed, fixed additions instead of market returns. And it's non-participating, so the policy doesn't share in the insurer's profits. Benefits are fixed according to the plan terms. The primary goal is to provide a guaranteed corpus to meet a child's future milestones, such as higher education or marriage. Note that the proposer, typically a parent or guardian, owns and pays for the policy, and vesting transfers ownership automatically to the child on the policy anniversary after they turn 18. This plan focuses on guaranteed benefits and predictable outcomes. First, there's a guaranteed benefit, a risk-free lump sum at maturity designed for milestone planning. Second, the plan offers flexible payouts at maturity. You can take the whole amount as a lump sum, defer the lump sum for up to 7 years, or receive the payout as installments over a period of 2 to 7 years. Third, there is an inbuilt waiver of premium. If the proposer dies or suffers an accidental total permanent disability during the premium payment term, future premiums are waived, and the policy continues with full benefits. Finally, potential tax benefits may be available under prevailing income tax rules. Please consult a tax advisor for specifics. Guaranteed additions are the backbone of the plan's guaranteed growth. A guaranteed addition is a fixed percentage of total premiums paid and is added to the policy at the end of each policy year, starting from year 1 until the policy ends. The rate of addition depends on your annualized premium band and your premium payment term. For example, according to the brochure, for annualized premiums between 50,000 rupees and 1 lakh rupees, guaranteed addition is 5.5% if you choose a 7-year premium term, or 6% for a 10-year premium term. For 1 lakh rupee to 2 lakhs rupees, guaranteed addition is 5.75% for 7 years and 6.25% for 10 years. For 2 lakhs rupees and above, guaranteed addition is 6% for 7 years and 6.5% for 10 years. Important point: if the life assured dies during a policy year, the full guaranteed addition for that year is still payable as part of the death benefit. The maturity benefit is payable if the policy is in force and the child survives to the end of the policy term. The payout equals two components added together. 1. The sum assured on maturity, which is the base sum assured of the policy, and 2. All accrued guaranteed additions accumulated across the policy term. At maturity, you can choose how you want to receive this money: as a single lump sum, as regular installments, monthly, quarterly, half-yearly or yearly, spread over 2 to 7 years, or a combination of a partial lump sum plus installments. Note that you must inform the company in writing of your settlement choice at least 3 months before the maturity date. If unfortunately, the child dies during the policy term while the policy is in force, the death benefit is payable immediately, and the policy terminates. The amount paid is the higher of the two calculations. Calculation A: sum assured on death plus accrued guaranteed additions, or Calculation B: 105% of total premiums paid up to the date of death. Also note, the sum assured on death is defined as the higher of the base sum assured or 11 times the annualized premium, as per the plan terms. Once the death benefit is paid, the policy ends, and no further benefits apply. The waiver of premium is automatic and very important for protecting the child's future. It is triggered if, during the premium payment term, the proposer either dies or suffers an accidental total permanent disability. If triggered, all future premiums due under the policy are waived. The family does not need to make any more payments. The policy continues to be in force as if premiums were being paid. Guaranteed additions continue to accrue each year, and the full maturity benefit remains payable at the plan maturity date. This keeps the funding plan intact, even if the proposer can't pay anymore. ATPD is specifically defined and must meet strict conditions. The disability must be caused solely and directly by a bodily injury from an accident and must occur within 180 days of that accident. Qualifying impairments include total and permanent loss of sight in both eyes, physical severance or total permanent loss of use of two limbs at or above the wrist or ankle, total and permanent loss of sight in one eye and loss or severance of one limb. There is a permanence rule. For a claim to be payable, the disability should have persisted continuously for at least 180 days and be certified as permanent by a company-appointed medical practitioner. An important note: the 180-day waiting period does not apply in cases of physical severance. Let's walk through the sample illustration used in the brochure to make things concrete. Mr. Raghav, aged 35, buys the policy for his newborn son Aryan. He pays an annual premium of 1 lakh rupees for a premium payment term of 10 years, with a policy term of 20 years. The illustration shows 3 possible outcomes. Outcome 1, full term. No unforeseen events occur. Total premiums of 10 lakhs rupees are paid over the first 10 years, and the maturity benefit at year 20 becomes 23,68,650 rupees as shown in the illustration. Outcome 2, waiver of premium. If Mr. Raghav passes away in year 7, future premiums are waived. The policy continues. Guaranteed additions keep accruing and the maturity benefit shown is still 23,68,650 rupees. The planned amount is paid in full. Outcome 3, death of the life assured. If Aryan, the child, sadly dies in year 7, the illustration shows a death benefit of 15,74,900 rupee payable, after which the policy terminates. These outcomes show the plan's guarantee features and the protective value of the waiver of premium. Who can buy this plan? And what are the limits? Let's have a look at the key parameters. Child's age at entry. Minimum 30 days and maximum 15 years. Proposer's age at entry. 18 years to 65 years. Child's age at maturity. Minimum 18 years, maximum 35 years. Policy term. Between 15 years and 25 years. Premium payment term. 7 years or 10 years. Fixed choices. Minimum annualized premium. 50,000 rupees. Minimum sum assured. 3,50,000 rupees. There is no maximum limit for the annualized premium and sum assured. However, both are subject to underwriting, which means the insurer will assess your health, income, and other factors before approving very large cover amounts. On premium frequency, premiums can be paid yearly, half-yearly, or monthly. Half-yearly mode equals about 51% of the annualized premium per half year, and monthly mode equals 8.5% of the annualized premium per month, and for monthly mode you must pay 3 months premium in advance. Regarding policy loans, once your policy acquires a surrender value, you can take a loan against it, up to 50% of the policy's surrender value. Interest rates are variable. The brochure gives an example rate for financial year 2025-26 of 8% per annum, compounded half-yearly, but this is subject to change. Premiums shown are exclusive of taxes and any applicable charges. Tax treatment depends on prevailing laws and you should consult a tax advisor. Now let's understand what happens if premiums are missed. If all premiums are paid on time, the policy stays in force. If you miss a premium due date, you enter a grace period, 30 days for yearly or half-yearly modes, and 15 days for the monthly mode, during which you can pay without penalty. If premiums remain unpaid beyond the allowable time, the policy may lapse, and lapse means the policy provides no benefits. If at least one full year's premium has been paid, a policy may become reduced paid up. It continues with proportionately reduced benefits, and the waiver of premium benefit ceases. The policy can be revived within a specified period. Revival is possible within 5 years of the first unpaid premium, subject to payment of dues, accrued interest and proof of insurability. You can also surrender the policy any time after one full year's premium is paid, in which case you get a surrender value as per the policy rules. There are some important exclusions to be aware of. Under suicide exclusion, if the life assured dies by suicide within 12 months of policy start or revival, the benefit is limited to the higher of 80% of total premiums paid or the surrender value. If the proposer dies by suicide within 12 months, the waiver of premium benefit will not activate. For the waiver of premium on ATPD, certain causes are excluded. These include infections, unless due to accidental wound, drug or alcohol abuse, intentional self-inflicted injuries, involvement in criminal acts, war or specific military operations, and participation in hazardous sports such as mountaineering, parachuting or racing. Also remember the free look period. You have 30 days from receiving the policy document to review it and return it for a refund if you disagree with the terms, subject to deductions like proportionate risk premium and stamp duty. This plan is a good fit if you are a parent, grandparent or legal guardian of a minor child aged 30 days to 15 years, and you want a guaranteed, disciplined, long-term savings fund for a child's future milestones such as higher education or marriage. It suits those who prefer fixed guaranteed returns rather than market-linked volatility, and who value the security of the inbuilt waiver of premium. Conversely, consider other options if you are looking for higher market-linked returns and are willing to take investment risk, if you need higher liquidity or short-term solutions, or if you only want pure life cover without a savings component. For that, a term plan is more suitable. It's crucial to approach any financial decision with careful consideration. First, take your time to thoroughly assess your current financial situation. Next, clearly factor in your personal risk tolerance, your specific income needs for the future, and your overall long-term financial goals. Most importantly, we strongly recommend talking to a qualified financial expert. Their insights can help ensure you are making the most informed and suitable decision for your unique circumstances. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.